Imagine for a second that you have just wired over $150 million to a massive industrial shipyard. You are now the proud owner of a colossal floating city. It is an asset far more expensive than a commercial airliner, holding more sheer monetary value than the entire economic output of some small island nations. But here is the bizarre catch. You are not going to put a single piece of your own cargo on this vessel. You are not going to manage the daily logistics of moving goods across the dangerous ocean. In fact, you might never even see the ship in person for as long as you own it. So how exactly does dropping a fortune on a gigantic piece of steel floating out in the middle of nowhere actually make you any money? Welcome to the high-stakes, heavily guarded reality of global shipping, where the massive company logo painted on the side of the hull almost never belongs to the person who actually owns the boat. When most of us look at a standard cargo ship, we just see a big metal box carrying smaller metal boxes. But these vessels are absolute marvels of extreme engineering. We're talking about over 40,000 tons of highly specialized steel that has been meticulously welded into a hull. This structure has to be flexible enough to bend and twist in massive, violent ocean swells without snapping in half. Deep inside that steel belly sits a two-stroke marine engine taller than a 4-story building, cranking out a staggering 100,000 horsepower. It is a self-sustaining powerhouse built for a brutal, relentless operational life of 25 years. You cannot just pick one up at a local dealership. You have to custom order it from mega yards in places like South Korea or China, and the final price tag is entirely at the mercy of chaotic global forces. It fluctuates wildly based on the cost of raw iron, the specific engine technology you choose, and the shipyard's capacity at that exact moment. But the biggest wild card of all is global demand. Shipping assets do not appreciate steadily like a piece of prime real estate. They behave much more like highly volatile meme stocks. When the global economy is booming and everyone is buying things, the value of these ships skyrockets. But during an economic downturn, the collapse is breathtaking. During the massive financial crisis back in 2008, ship values plummeted by over 40% in just a few months. A vessel that cost $100 million to construct was suddenly worth maybe $60 million before its hull even touched the salt water, simply because global demand evaporated overnight. It is enough to give any standard investor a severe case of analysis paralysis, yet people still eagerly play the game. To understand why, you have to look at the 3 entirely separate layers of the global shipping cartel: the builders, the operators, and the owners. They are almost always completely different corporate entities. You know the operators. You see their massive logos, like Maersk or MSC, painted brightly on the side of the ships. They handle the complex web of global logistics, moving electronics, cars, and clothes from factories to your front door. But they really prefer to own as few of these physical ships as humanly possible. To them, owning the physical vessel is a colossal, unnecessary financial risk. So, who actually holds the deed? It is usually a hidden network of incredibly wealthy entities. It could be a multi-generational Greek shipping family operating out of Athens, treating the ocean like a giant chessboard where buying low and selling high is a deeply ingrained art form. These families alone control roughly a fifth of the world's entire merchant fleet. Or maybe it is a massive Japanese leasing conglomerate buying ships purely to use as depreciating assets on their corporate balance sheets. Sometimes it is just a private equity firm in a sleek London office. These owners do not care about how a video game console gets from Shenzhen to Los Angeles. They are running a pure, unadulterated, high-stakes leasing business. To get their money back, they have to rent out the steel. And they do this through 3 main types of charters, each with a totally different psychological and financial risk profile. The first option is the time charter. This is the safe, conservative bet. The operator rents the vessel for a fixed daily rate over a specific period, let us say $40,000 a day for 3 years. The owner provides the ship, the crew, the maintenance, and the insurance. The operator pays for the fuel and port fees. It is perfectly stable, but there's a major catch. If you lock in a rate and the market suddenly booms the next week, you're stuck missing out on millions. The second option is the bareboat charter. In this scenario, the operator rents the physical vessel and absolutely nothing else. They hire their own crew, buy their own insurance, and fix the engine when it breaks. For the owner, the income is lower, but it requires absolutely zero effort. You literally hand over the keys and wait for the monthly checks to clear. But the third option is where things get truly insane. It is called the spot market. Here, ships are rented on a voyage-by-voyage basis. The rates swing violently based on seasonal demand, sudden geopolitical conflicts, or a random crisis. This is where owners build true generational wealth. When that massive container ship got stuck in the Suez Canal back in 2021 and paralyzed global trade, spot rates went completely parabolic. Ships that normally rented for $15,000 a day were suddenly demanding one. $150,000 a day. The fear of missing out gripped the entire global supply chain, and owners became billionaires almost overnight. But the hangover from that kind of high is brutal. Once supply chains recovered, those same rates crashed back down to earth, wiping out anyone who got too greedy. How do these hidden owners even afford to build these massive things in the first place? Because almost nobody is out there paying straight cash for a boat that expensive. The standard financial structure in this world looks more like buying a massive floating piece of real estate. You put down maybe 30% in equity, and the remaining 70% comes from colossal bank loans backed by the vessel itself. But to protect their sprawling empires, these owners use a brilliant, almost paranoid legal shield. If a massive shipping magnate owns 50 different vessels, they absolutely do not put them all under one giant corporate umbrella. That would be a catastrophic risk. Instead, they create 50 completely separate shell companies, usually registered in places like Liberia, the Marshall Islands, or Panama. One company exists solely to own one single ship. Why go through all that complicated paperwork? Because if one vessel goes hopelessly bankrupt or worse, has a massive environmental oil spill, the rest of the entire fleet remains perfectly safe from the fallout. It is a psychological firewall designed to protect generational wealth from the unpredictable chaos of the ocean. But there is a massive trap lurking just beneath the surface of all this debt. Let us say you borrow $70 million to buy a $100 million vessel. A year later, the market crashes, and the resale value of your ship drops to $50 million. You are now severely underwater on your massive loan. The physical collateral floating in the water is suddenly worth way less than the debt you owe on paper. The bank starts to panic and immediately demands a massive cash injection to cover the difference. If you cannot pay them out of pocket, right. Then and there, they seize your entire fleet. The history of global shipping is absolutely littered with the corporate remains of companies that got overly confident, over-leveraged their assets, and completely collapsed under the pressure. Even if you manage your debt perfectly, playing the game like a master, you still have to face a completely unpredictable enemy, changing global regulations. A physical ship is built to last for roughly 2.5 decades, but strict environmental rules are currently turning the entire industry upside down. The global push to decarbonize means there are sudden, mandatory demands for entirely new fuel systems, incredibly expensive engine retrofits, and massive exhaust scrubbers that cost millions of dollars per ship. Think about the incredible risk of innovation here. What happens if you build a state-of-the-art ship today that runs on liquefied natural gas, only to find out in a decade that the strict global standard has shifted entirely to green methanol? Your incredibly expensive vessel instantly becomes a stranded asset. It becomes way too expensive to operate, completely illegal to dock in certain major global ports, and virtually impossible to sell to anyone else. Its massive valuation drops to zero in the blink of an eye. Owners are constantly gambling on future fuel trends, global carbon taxes, and unpredictable geopolitical shifts. This industry heavily rewards extreme patience but brutally punishes any arrogance. Because of this chaos, ships are traded exactly like highly volatile commodities. A vessel bought for $150 million might surge to $180 million during a trade boom because desperate buyers need a ship right that second, or it could plummet to $80 million during a sudden market crash. Some of these owners do not even intend to operate the ship for its full lifespan. They just want to speculate, buying low, renting it out when the rates are high, and selling it off before the market turns against them. But what happens when a ship finally reaches the absolute end of its operational life? It does not just vanish into thin air. It has sailed one final time to the massive ship cemeteries, those billion-dollar ship graveyards located on the beaches of places like Alang, India, or Chittagong, Bangladesh. There, the vessel is intentionally run aground at high tide and meticulously dismantled piece by piece, mostly by hand. The owner gets paid strictly for the raw scrap weight of the specialized steel. Even in its final moments of death, a large cargo ship might yield $15 million just in scrap metal. It provides a final absolute financial floor to the asset's overall value. So why does this chaotic, highly fractured system actually work? Think about it from the perspective of an operator like Maersk. Owning every single ship in their massive global fleet would be incredibly capital intensive and loaded with a terrifying amount of debt. If global trade suddenly slows down, an operator with 500 owned ships still has to figure out how to pay 500 massive mortgages, even if those ships are sailing completely empty. By chartering the vessels instead, they maintain ultimate flexibility. If consumer demand drops, the operator just lets their short-term contracts expire and hands the keys back to the owners. The operator stays lean and agile, while the owner is forced to take the massive financial hit. This brilliant separation of ownership and daily operations takes all that extreme risk and spreads it out across the entire global financial system. When an operator goes totally bankrupt, the ships do not just disappear. The hidden owners simply take them back and rent them out to a surviving competitor. The logistics companies might completely die off, but the steel keeps moving across the water. Ultimately, owning one of these floating cities is not just about renting out pieces of metal. It means managing staggering amounts of debt, perfectly predicting macroeconomic cycles, betting your fortune on environmental regulations, and surviving brutal volatility. But when you multiply that intense strategy across hundreds of vessels, leveraging debt and reading the shifting tides of global trade, you finally begin to understand how modern maritime empires are really built. It is never about controlling the actual cargo. It is about the relentless, calculated mastery of risk.